Only 31% of actual millionaire portfolios are in public stocks. I analyzed 50 real portfolios from people with $2 million to 47 females, and what they actually own is completely different from what they tell you in interviews. These aren't what they say they own. These are actual account statements. And the patterns changed everything I thought I knew about building wealth. Here's how I got this data. I spent 3 months connecting with wealth managers, private bankers, and family office advisors. Some shared anonymized portfolio snapshots. Others let me see allocation reports with names redacted. All 50 portfolios had at least $2 million in investable assets. The average was $8.3 million, and the patterns were incredibly consistent. First, shocking finding. The average stock allocation was just 31%, not the 60% or 70% that financial advisors tell normal people to hold. Some portfolios had 0 individual stocks. The ones that did hold equities used very specific vehicles, mostly tax-managed funds at Vanguard and Fidelity, things like Vanguard Tax-Managed Capital Appreciation Fund, or Fidelity's SAI funds that regular investors can't even access without $10 million minimums. But here's what matters. They weren't chasing returns in the stock market. That phase was over. They'd already made their money. Now they were focused on keeping it and generating income without volatility. Second pattern. Real estate showed up in 47 out of 50 portfolios. The average allocation was 28%. But this wasn't rental properties they managed themselves. Nobody with $5 million is dealing with tenant calls at 2 a.m. This was private REITs, real estate syndications, fund investments in commercial properties. Some used platforms that pool investors for apartment complexes and industrial buildings. Others had direct relationships with sponsors doing $50 million developments. The minimum checks were typically $50,000 to $100,000 per deal. Returns targeted 12% to 18% annually, and the income was partially tax-sheltered through depreciation. This is the secret that nobody talks about. Once you have serious capital, you get access to investment vehicles with completely different return profiles and tax treatment. Third finding, 86% held what they called alternatives. This category included private equity, hedge funds, venture capital, and private credit. The average allocation was 23%. These weren't Robinhood accounts buying Tesla calls. This was committed capital in funds with 5 to 10-year lockups. Minimum investments from $250,000 to $1 million. One portfolio had $4.2 million in a single private credit fund yielding 11% annually. Another had $1.8 million spread across 3 venture funds. The common thread was access. These opportunities don't show up on public markets. You need relationships. You need accredited investor status. You need enough capital that fund managers want to work with you. Fourth pattern. Bonds were almost non-existent in the traditional sense. Only 12% average allocation to fixed income. And when bonds did appear, they weren't Vanguard Total Bond Market. They were municipal bonds for tax-free income, or structured notes from private banks creating custom return profiles. Several portfolios held absolutely 0 traditional bonds. The wealth managers said bonds don't make sense when you can get better yield from private credit with similar risk. Fifth finding. Cash positions were massive. The average was 11%. Some portfolios held 18% in cash and cash equivalents. This seems crazy when savings accounts pay 4%. But there's a strategy here. High net worth individuals keep dry powder for opportunities. When a private deal comes across their desk, they can move immediately. No selling positions, no tax events, just write a check. Plus, they weren't keeping cash in regular savings accounts. This was money market funds at Fidelity yielding 5.2%, or sweep accounts at private banks paying 4.8% with FDIC coverage across multiple institutions. Some used Treasury bill ladders. One portfolio had $900,000 in a 3-month T-bill ladder yielding 5.4% with 0 state tax. Sixth pattern. The banks they used were highly specific. 43 out of 50 had accounts at either J.P. Morgan Private Bank, Goldman Sachs Private Wealth Management, Morgan Stanley, or UBS. These weren't checking accounts. These were private banking relationships requiring $5 million to $10 million minimums. The services included custom credit lines at 3% to 4% interest, estate planning, tax strategy, and access to exclusive investment products. Several portfolios had borrowed against their assets at 3.2% to buy more real estate yielding 14%. This is how wealthy people think. They don't save up and pay cash. They use cheap debt to acquire appreciating assets and keep their capital deployed in higher return opportunities. Seventh finding. Business ownership and equity compensation made up huge portions. 34 portfolios included significant positions in private businesses or company stock from employment. The average for this category was 19% among portfolios that had it. This wasn't money they invested, this was wealth they built. But it confirms what everyone already knows. Most millionaires made their money from ownership, not from investing. Eighth pattern. International exposure was minimal. Only 8% average allocation to non-US assets. This surprised me. The conventional wisdom is to diversify globally. But actual millionaires are heavily concentrated in US assets. US real estate, US private equity, US businesses. Some wealth managers explained that international investing adds complexity, tax headaches, and currency risk without meaningfully better returns. Ninth finding. Cryptocurrency appeared in 7 portfolios, always under 3% of total assets, usually through Coinbase Prime or Gemini institutional accounts, not regular exchanges. A few held Bitcoin through Grayscale products or Fidelity's crypto services. None held altcoins or NFTs. The ones who had crypto treated it like venture capital. High risk, small position, long time horizon. 10th pattern. Life insurance played a huge role that nobody mentions. 38 portfolios included cash value life insurance or premium financed policies. These weren't term life policies. These were whole life or indexed universal life policies with millions in cash value. Some were using these for tax-free retirement income. Others were doing premium financing, where banks lend you money to pay massive premiums, building cash value that exceeds the loan cost. One portfolio had a $15 million policy with $3.7 million in cash value, earning 5% tax-free. Another was paying $180,000 annual premiums on a $25 million policy, fully financed by a bank at 4.1% interest. The arbitrage and tax benefits make these vehicles attractive at high net worth, even though they make 0 cents for normal investors. So what does this mean for you? You probably can't copy these portfolios exactly. Most of these investments require accredited investor status and 6-figure minimums. But the principles matter. Millionaires prioritize tax efficiency over raw returns. They use debt strategically instead of avoiding it. They focus on income-producing assets, not growth speculation. They keep significant cash for opportunities. And they own businesses and real estate, not just stocks. 3 things you can implement today. 1. Increase your cash position to 10% to 15% of your portfolio. Use a high-yield savings account at 4.5% or Treasury money market fund at 5%. This gives you stability and opportunity capital. 2. Explore real estate beyond owning your home. Look at platforms like Fundrise or CrowdStreet that let you invest in commercial real estate with $10,000 minimums. The returns and tax benefits move you closer to how millionaires actually invest. 3. Build tax efficiency into everything. Use Roth conversions. Harvest tax losses. Consider municipal bonds if you're in a high tax bracket. The difference between 8% taxable and 5% tax-free is huge over decades. The biggest takeaway is this. What financial advisors tell regular people to do is not what happens at high net worth. The asset classes change. The institutions change. The strategies change. You don't need $10 million to apply these principles. But you do need to understand that building wealth and preserving wealth are completely different games. And the sooner you start thinking like the portfolios I analyzed, the faster you'll get there.